Good morning, everyone, and a very warm welcome to our annual Real Estate Breakfast Seminar. My name's Chris Major, and I head up the K&L Gates real estate team here in London. We're delighted to be hosting this morning one of the first live events of this back-to-school period. It's such a pleasure to be able to meet again in person after all the months of being cooped up at home. So thanks very much for coming and joining us. A hearty welcome also, minus the bacon butties, to our friends and colleagues who are joining us on our live stream today. We look forward to hearing from you with your questions and comments through the chat box facility on your screen, which we will pick up during the discussion. This is also our first real estate event in this our new conference room. So thank you for, in a sense, coming to christen it today. You may have noticed from the sign outside that we have called this conference room the Wren Room, which I suppose may cause Jonathan Ross a bit of bother if he ever pays a visit. Sir Christopher Wren, of course, designed St. Paul's Cathedral, and you may have either seen or heard about the inscription on his tomb, with the tomb being in the cathedral. It reads, Si monumentum requiris circumspice, and you can tell I didn't do Latin at school, which means if you seek his monument, look around you. Perhaps with good cause, not the most modest of epitaphs, and I wonder if for our purposes today, we might amend it to read, if you seek his monument, please shufty up to the window a bit and look left. But I'm not sure what that is in Latin. Nevertheless, we're very pleased with our new conference room, and we hope you like it too. Now, may I introduce our speakers for today? Sabina Kalyan will need no introduction to many of you. And Sabina, we are very grateful to you for speaking to us today and at this event now for several years. Sabina is the Global Head of Strategy and Research for CBRE Global Investors. Likewise, it's a great pleasure to welcome Mike Phillips back again today. Mike, who will also be well known to many of you, is the UK editor of BizNow, the world's largest real estate media business. And thirdly, we are delighted to have with us today Denis Charles, who is a real estate partner in our Paris office. Denis has travelled from Paris to be with us today, and we're very much looking forward to his perspective on life from the other side of La Manche. In fact, we have two Denises here today, as Dennis Keeley has flown over from our New York office, where he too is a real estate partner of the firm. So welcome, Dennis. And I hope you have the chance to meet one or both of the Denises after this section, if you haven't met them already. Our format today is that Sabina is going to kick off with her presentation. She'll hand over to Denis to give his, and then Mike will give us his customary roundup and field your questions. This should finish by 10:30, and then please do stay for more coffee and pastries and chat, which will be served in here. I've got to give you a couple of somewhat obvious housekeeping points. Should you hear the fire alarm, marshals are on hand to direct you to the nearest fire exit. And if you could put your phone on silent, that'd be much appreciated. With that, I'll hand over to Sabina.
Well, thank you very much for that kind introduction. This is my first time speaking in front of actual people since February 2020. So if I'm a little bit rusty and freaked out, then do bear with me. It was so lovely to see everyone just mingling earlier and that buzz of chat. I think we've really missed it. And my other caveat before I start is that in February of 2020, I was wandering around our office saying to people, well, I've booked my Waitrose slots. This tells you how middle-aged and middle-class I am, and from Surrey I am. I've booked my Waitrose slots till June, so we'll be fine. So when I give you all my prognostications and forecasts, you can bear that in mind and adjust accordingly. But it is lovely to be back to school. Some of us with a little bit more weight than when we left, and then trying to exercise to lose it, and then doing stuff like this. But we continue, battered but and bruised, but we go on. So where next for global real estate? So let's start off a little bit with the pandemic, sadly, because we have to. It's so influential in terms of the timing of the recovery. I'm going to talk a bit about what's going on in the economy, which is so related to that too, get into some of our real assets forecasts, and how we think we're going to try and find value and what we're going to do. And it's challenging times, right? We know the uncertainty and the pain in retail and hospitality. We're all back in the office today, but few others are. So what's the future of office? There are huge questions facing us right now as we live through this period of kind of nuts behavioral change. So we'll try and figure it out together over the next 20 minutes. Let's start off with the pandemic. The good news, there is some good news, is that the Delta variant that we're living with right now is not an escape variant. In other words, it might weaken the vaccine response, but it doesn't evade it. And that is good news. What I have here are the caseloads around the world, and you can see the UK and US in the two green colors. Our caseloads are huge, but thankfully, the hospitalizations and the deaths are not commensurately huge, although very tragic when they occur. And you can see, actually, if you look at France in light blue, Japan in purple, they're actually sort of cresting off that wave now. Where you are seeing it start to tick up is in parts of Asia Pacific, who, if you look at the lurid pink and purple and orange colors, had nothing last year. They had 2020 of very good pandemic management. But because they were slower to vaccinate, they really felt Delta. And you can see it in Sydney and Melbourne that are locked down again 2 years in. I think if someone said to me I would have to lock down again, I'd cry. I think there is a weariness with locking down. So the situation is very different. And as global real estate investors, I would say that the locus of risk last year was the US and UK. The locus of risk in the first half of this year was continental Europe because it was so slow to get the vaccines out. But now it has shifted, and it probably is more in parts of Asia Pacific that have been slower to vaccinate. And maybe back to the US because, well, I'll get to that in a moment. They haven't vaccinated, or there's a supply exceeding demand problem in the US. But this is the Delta variant, and this is why I'm cautiously optimistic right now and about winter, unless something else creeps out. This is the winter wave in the UK on the left. So you can see the cases in dark green, they ramp up, and then shortly after the deaths in light green, very sadly and tragically ramp up too. And then on the right, you have the Delta wave, and the cases ramp up kind of very similarly, right, in light blue. But the deaths stay low, and they're predominantly in people who aren't vaccinated or have pre-existing conditions. So vaccines work, guys. That's the good news. Let's keep that in mind as we have our vaccines and our boosters. But to my locus of risk point, where is the key risk? If you're a global investor, where should you be worried? These are the number of vaccines administered by population in the different countries. So you can see Israel in dark green took a massive lead. The UK, US, so UK here is in light blue, US in pink. They took early leads too, but we have been overtaken now, and we've been overtaken by places like Singapore, China. Bit of caution there because China is vaccinating fast, but the vaccine doesn't necessarily work. But look at the US in pink. It's now been overtaken basically by the EU and by many places in Asia Pac. So I think if I were an investor, I'm worried about economic disruption, further lockdowns, supply chain issues. For me, the locus of risk now is more US and maybe parts of Pacific and parts of Asia. I think Europe actually looks pretty good. And part of the reason why, in particular, continental Europe looks good is that they really cracked on with vaccinating children, where we in the UK have been a little bit more hesitant about rolling out to the under 18. So when you look at the sort of vaccination rates there, they're very strong. So actually, in sharp contrast to last year, I would say continental Europe and maybe the UK feel like the pandemic management is perhaps a little bit better than the rest of the world, but let's wait and see what other variants have in store. I'm very cautious about, trying to sound too optimistic here because we know this is going to be a long slog. That all feeds into the macro outlook. So we know this is going to be choppy, right? With the different regions of the world vaccinating differently, and opening up differently. Like, it's amazing that we have our K&L Gates partner over from the US, but we can't yet get into the US. So I'm going to Italy at the end of this month, and my goodness, I think it's taken about 2 days of admin time just to figure out all the injections. I mean, we're living in a world that is opening up differently and lots of supply chain disruption. So we know that this recovery is going to be choppy. It's going to look interesting. It's not going to be a typical post-recession where you all drift out of it together. Superficially, the 2021 numbers, so this year, looks pretty good. On this chart, I've got our economic growth forecasts for this year in dark green, relative to 6 months ago in light green. So you can see there's been a lot of change, even on 6 months, and the change has all been positive. And the reason for that is that I think we underestimated just how desperate we all were to get out of our houses and go and eat a meal in a restaurant, or take a staycation, or take a vacation abroad if we could kind of figure it out and stomach the risk. No one spent any money in 2020. Our savings around the world were at record highs as households because we just couldn't spend our money on anything, right? And so people have been running down those savings. If they're in the US, they've been spending their stimulus checks. And we have had an absolutely bonkers recovery in leisure, retail, hospitality, domestic hospitality spending. So the numbers are good for this year. And actually, if we go to the next 5 years, I think it's actually a pretty robust picture globally for economic growth. These are our 5-year forecasts. And again, you've got the revisions in light green, so not much change. And as context, all of these numbers are above the trend growth rate for that country. So if you take, I don't know, the European Union as a whole, trend growth would typically be like 1 to 1.5%. And they'll be coming in at somewhere like 2 to 2.25%, depending on where you are. So for every country, this is going to be an upswing. And as we sit in the middle of this quite painful period, it's important to keep our eyes on the prize and recognize that as economies open, job vacancies are rising. And in fact, the problem is finding the workers to fill those job vacancies. So I'm hoping it feels quite frothy over the next 5 years, partly because we still have so much money swirling around the global system from all the central banks and all the emergency measures they put in over the last year and a half. So, and if you're in the US, if you guys are investing in the US, not only do you have the monetary policy still swirling around the system, but you have a pretty, unprecedented level of fiscal policy swirling around too. Big infrastructure spend bills, although scaling back a little bit. There's going to be a lot of build back better spending. You've got the European recovery program in the EU that we wait to see the details of. But if you were looking at Spain, Italy, I would imagine there'd be some real upside to some of those forecasts there if they get the money turned on. So this could be, as we pull out, a pretty buoyant period to invest in with real job growth, really good economic growth, consumer-led as we come out of this. The fly in the ointment as income-seeking real estate investors is what happens with inflation. And for those of us who are debt financed, what happens with interest rates. And the big change to our macro view over the last 6 months hasn't been on the economic growth side, which remains pretty decent. It's been on when we see interest rates start to rise and when central banks try and pull money out of the system and just get us back to something like normal. So this is a test to see who knows all the flags of the world. Can you all pick New Zealand from Australia? Anyone know the two on the first left? I'll buy you a beer afterwards. This is great when I present this to our executive committee because you really see how truly global is CBRE Global Investors. The key point of this chart is a lot of the smaller markets will see interest rates rise very soon, or already are. Korea already raising interest rates. Czech Republic, well, probably New Zealand. A lot of the markets that didn't suffer huge pandemic damage, like say a Korea, they just managed it really well. They didn't see massive, economic scarring, so they can just raise rates and carry on as normal. But even the majors now, so UK maybe start of 24, US somewhere in 23. We now think rates will rise faster in general. And the one thing I would say here is that central banks are trying to sort of counter market expectations. I was in a call with one of the governors of the Reserve Bank of Australia yesterday, and he was saying, we think the markets are too aggressive. They're pricing in Australian interest rate rises end of 22, and we think that's too aggressive given what Delta has done to the Aussie economy. But rates will rise and bond yields will rise. But I don't think this is something to panic about. If you look at these forecasts and where you end up kind of like, 2 to 3%-ish, maybe higher if you're in China. You're kind of back to where you were in 2017, 18. This isn't kind of crazy interest rate levels or bond yield levels. What is this predicated on? This is predicated on our belief that inflation is not going to go nuts. It's going to feel like it's going nuts because right now you're going to see prints that are 4%, 5%, 6% because you're comparing to a year ago when we were locked down, or a year ago when we had Eat Out, what was it, Eat Out to help out in the UK? And you had VAT cuts to help out the hospitality industry. So of necessity, the price today is a lot higher than it was a year ago. So don't get too swayed by the prints that are coming out now, all for the next 6 months. There is a big debate as to how far the economic disruption becomes permanent scarring. But I would say that when I look at like forward prices for commodities and forward prices for lumber, my goodness, everyone knew what the lumber price was in January when it was going up 30% year on year. I'd never heard anyone in investment committee ask me about lumber prices until this year. But the forward prices have come down. So Delta variant, as it's brought back some of that economic froth. My personal view is that inflation will be higher than it was before the pandemic. So rather than 1.5%, maybe it's 2.5%. And that comes through in our investment themes. I believe, and this might sound glib, that what we do is actually pretty simple. But it's also really hard because what we are trying to do is be behavioral futurists. We're trying to understand, how do people, our end tenants, want to live, work and play today and in the future? And rather than just sort of lazily delivering them the real estate that we happen to own and that we had 15 years ago with a few superficial changes to it, we need to think really deeply about, how do people want to live? How do they want to shop? Where do they want to work? When do they want to work? And if we try and build and create that real estate, it will have enduring value in our portfolios, which, like I say, are core and long-lived. So we've got to figure people out. And the big problem has been trying to figure out how the big structural trends we were investing according to, so technological change, demographic change, hyperconnectivity, this is the interesting one, right? This is the idea that if you get a shock anywhere in the world, it's with us all in a month. So that can be a financial shock. It can be an epidemiological shock. It can be, unfortunately, a cop killing a black guy in America in riots, and then suddenly you've got Black Lives Matter protests around the world. Everything transmits fast. So when we build core portfolios, they need to have a measure of anti-fragility. They need to have a measure of resilience to that kind of rapid shock. In social and sustainability, that was huge before the pandemic. How does that interact with this massive behavioral change that we're experiencing? What is the future of flexible working? Fear of density. There are a lot of people dialing on Zoom who maybe still do have a fear of density, whether that's on the train, whether that's in this office and seeing this group of people. You might have seen me earlier just like taking a photo of this room because it's the first time I've been in a room this full, and it is kind of slightly strange. The idea that home is now a social space, right? So maybe that's now my cinema, and it's now my gym, and it's now my restaurant. It's where I host people. And to give you a worked example of this, we own a UK residential developer. And before, in our Zone 2 residential blocks, we might have had 70% one-bed flats and 30% two-bed flats, aiming at young professionals renting for the first time in London. And that now switches. It now switches. And they can't afford to pay more, so that affects the IRR, doesn't it? But they need to have the potential for a home office, the potential for somewhere to put their exercise bike or whatever, right? It's just changed how you view resi. And just as no one ever asked me about lumber prices before this January, no one ever asked about HEPA filters and air quality. And is there a stairwell? How do they get into the building if they don't want to use the lift? Heightened focus on wellness and ESG. How do these two things interact, and what do you do with the results? I think what we think you do with the results of that is think that people now have got some measure of flexibility and they want to keep it. And the portfolios that we build have to reflect the structural change to retail that we've been through and the structural change to office that is occurring. And this is the message from private markets. This is the composition of the FTSE Nareit index. So this is listed real estate. And you can see that in the year 2000, 50%, so the two dark green chunks of REITs were in office and retail. And today, that's about 20%. Residential has always been far bigger in listed than in private markets. It's been kind of 20%. Healthcare has always been bigger, but has gotten bigger. That senior living medical office. And that big chunk of gray, which is logistics, data centers, self-storage, that's gotten bigger. And we think that that is the way that the private core portfolios will go. So when I started in real estate back in the mists of time in the last millennium, and I worked at IPD, you ordered the sectors, office, retail, then there was this tiny thing called industrial, and then other, which had about this much resi in it. And we think it'll look much more like this. So a big chunk that's logistics, and you have to get very fine-grained of what's in there in the dark green. A big chunk of residential, and we're going to have to create that together, right? That's not an institutional sector in many markets. And that will contain all sorts of things: multifamily, single family, for rent housing, senior living, student housing, affordable, fine-grained resi. Then there'll be a chunk that's office that will still survive, but more of that will be in niche like life science than it will be in CBD. And then there'll be healthcare as a serious chunk, and there'll still be retail, but it will be far smaller. So we feel if we're creating portfolios now that survive into the future, this is much more what the mix is going to be like. And that reflects everything that we're doing. And it certainly reflects our preferred strategy. So I'll end on this side. Effectively, what we're trying to do is say, where do we still have conviction post-pandemic? And in a sense, we're doubling down because we were very overweight logistics and residential going into the pandemic. They performed very well. We still think they have all the structural tailwinds. So we're doubling down, but we recognize that pricing is kind of, well, it's rational, but for those of us who were old and remember when you could buy logistics for like, I don't know, I remember actually like looking at data in the 80s when you could buy it for like double-digit yields. It feels painful. So for things we have real conviction in, we will build as well as buy. And that is typically logistics residential. Number two, even though now feels weird, remember we're on the cusp of a really good cyclical recovery. Don't be afraid of that, buy into it. And that will include things like leisure hospitality. It will include best-in-class CBD office, because when the economy creates jobs, office demand will go up. Maybe not as much as it did in previous recoveries, but it will go up. And anything that's to do with consumer spending. So your sort of hospitality, leisure, some types of retail, the stuff that's going to survive. And the third one, there is going to be market dislocation, but it's going to be different to after the GFC. After the GFC, it was typically driven by debt going wrong, right? And you could buy stuff, so you could buy secondary units, you could buy stuff that was coming out of the banks. We feel this is going to be driven by two separate things, and one of them is kind of almost running out. So last year, you could buy hospitality, leisure hotels at deep discounts, and that was a great opportunity. In fact, if last year, sort of like May to kind of August, you could buy anything at a 5 to 10% discount because so many people were out the market. That closed very quickly, and we kind of feel maybe that hospitality window is closing too. The other type of market dislocation I feel is going to come from maybe open-ended core funds, funds that are overweight in what I would call legacy real estate. So maybe they still have too much retail, maybe they just have too much kind of okay, but a little bit boring commodity office. And they need to get rid of some of that stuff and reorient themselves towards logistics and resi and some of these niche sectors. And we're already seeing, particularly in the US, opportunities come to us very quietly of people who need to get out of some of that stuff. And some of it will represent value, and some of it will represent a really good redevelopment opportunity. So that, I think, is the kind of market dislocation we're going to see, which is people struggling to make their portfolios future-proof and to move their portfolios with times. You know, at the end of the day, as I always say, we're a very simple business. We just have to listen to our tenants and our end users. End users have told us for years they don't want to shop in the way they used to shop. And they're now telling us they want to use offices differently. I'm not saying office doesn't survive and none of us come back, but it's just going to feel and look different. And we need to make sure, as good real estate investors, that we move with that. But overall, I hope I leave you with a message that's a little bit positive. I do think that vaccines work, and hopefully we're not going to have as bad a winter this winter as last winter, and that we need to orient ourselves for recovery. So it's lovely to see you all here. Some of you are now smiling. I'm still smiling, so that's a good thing. And I'll hand over to the next speaker. Thank you very much.
So let's move on France. So France is quite, I would say, different from the UK. We might be a little bit late from the UK, meaning that we are still living downtown. We are not living in the suburb. And so the commute is quite an issue for us. So it means that basically I would not be too pessimistic with respect to offices. So we are seeing the beginning of the relocation of the market. Office is quite strong yet, but we see that people are now looking at moving and trying to working from home. But it is brand new, much different from the UK. So I would say that offices, on a general matter, has still, I would say, 10 years to go. We'll see 10 years ahead what it will be, but still, yeah. So let's move on French real estate market. I will speak on figures. It might be a little bit boring, but hopefully I will make it, let's say, user-friendly. So I would speak about the French market with a view on logistics. As you see, logistics is the main real estate assets. Everyone is relocating to logistics. So basically, the French market is not there, but still good. So we are only 22% behind what we used to be in terms of investment, only 8.2 billion this first semester. And we saw a good first quarter. And surprisingly, the second quarter was slower. And thanks to COVID-19, this summer was quite quiet. So for once, it was good. People with COVID wanted very much to enjoy their summer break. So we are very optimistic with the third quarter when we see that we will have a lot of deals going on. Surprisingly, as far as deals number are concerned, we see that the numbers of deals were basically the same. So it means that at some point, we shifted from high-value deals to smaller deals, and mainly it can be explained by logistics. Formerly, we used to have jumbo deals with offices worth more than 200 million euros. As we will see later, those deals were very limited in number last year and this year. And we shifted to logistics, and logistics, as we will see, smaller deals. Most of the time, logistics, you have deals less than 10 million, and most of them are less than 10 million and above 50 million, up to 100 million. So it does explain that. We see that there has been a relocation on market. So you see that logistics now represent 18%, so which is quite a portion of the market. And it has raised while retail dropped, obviously. So offices stay on top basically because the value of the offices is still high. So you don't need much deals, but it does represent a large number when it comes to investment. But logistics is the asset growing with a margin increasing and increasing. What we can see is the compression of yields. So you said, I remember logistics used to be 12% of yield. You can remember that 10 years ago. And so you see all the yields are compressing and merging, converging together. So now, when you look at logistics, it's not far away from retail and not far away from offices. Only very limited offices in the QCA, meaning the Paris business limited centers, Golden Triangle. So only those offices are worth less than 3%, but otherwise it is more than 3%. You see La Défense is 4%. And so you can see now logistics being worth more than quite towers in La Défense, which is amazing. So we see that in logistics, at least for France, there is a threshold people are not willing to cross. So it stays at 3.5% for exceptional assets. People don't want to go beyond because they are afraid that it will become crazy, basically. It is different from Germany, where we can see yields at 3%. So in Germany now, it's a market where this is no way that it can be, let's say, worth the investment. It is already booked, I would say. So I think there is a good margin in France for logistics. When you look at the typology of deals, as I said, the market has shifted. You see less mega deals. When I say mega deals, I mean deals above 200 million euros. Basically, we haven't seen much office deals. Office used to be higher than 200 million euros. As we have seen less and less office deals, it does explain that the market has stretched a little bit. So it means that we have very little deals, maybe because people are looking at value-added deals transaction as well. So it means that actors are not the same also. You had institutional who used to look at defensive type of investment. They have been, let's say, wait and see to see what will be next. So it does explain this shift in deals value. It leads me to the typology also of investors. In France, we see that insurers have invested very little of their capacity, only 620 million compared to the 5 billion that they used to invest. It is explained basically by the fact that insurers used to invest in offices roughly. So offices with the huge question, what will be the offices tomorrow or maybe the day after? It does explain the situation. So most of them are investment funds, also with regulated REITs in France, OPCI and SCPI. These are REITs which grant tax savings. So these are the main actors gaining the whole portion of the market. We see also that we see some portfolio transactions there. So you see that 1.6 billion for the first semester was through a portfolio, and most of them was logistics portfolio. To explain, logistics is really the type of asset that fits this portfolio strategy. People are seeking at putting together a platform, so investing single assets with a yield of 4.5, 5.2, and then they put together with a proper platform, i.e. worth 100, 200 million euro. And as everyone is seeking at entering into the logistics, they give them the platform they are looking for in order to have this critical size. And so people are willing to pay the entry premium. And so it explains that logistics is very much the class of assets that will allow the portfolio transaction and also the pan-European transaction. So foreign investors hopefully are back. So we are good to see that they are back. It can be explained basically by the fact that France opened very much its borders. I must say that it is much easier maybe to enter into France than in the UK. I had to book my test, even though I will be back to France earlier. So we don't have this sort of form to be filled in, so it is much easier nowadays. And so I think it does explain that. And I was quite surprised about the fact that when you walk down the street, you don't see much people wearing masks here in the UK. Although in France we have been vaccinated, I think the same way you do, we still wear the masks. So I think masks is in the culture in France. So we are living with that, and it's part of the life. And we see that everyone is getting back to the office as well. So as I said, people are living downtown. So basically, as they are living downtown, most of them, they don't have much space, much room to have their own office. And so people are seeking to get back to the office and have hopefully their place. You are far away from us, far ahead in terms of agile and also open plan. In France, we are back 20 years back. And so we have our own offices. So it means that people there is still an appetite for offices, with the big question mark, what will be offices next day and the next year. So hopefully we will see insurance company getting back to the market and getting back to the office market. So as far as logistics, I would focus on logistics. There is a boom, a big boom in logistics, obviously. So we see this beginning of 2021 that 1.5 million square meters have been, let's say, exchanged. We have seen a lot of new leases, 76, and with a value of 1.8 billion. So it means really that France and the French market is the main target for logistics. I've been told that foreign investors are putting France at the priority. I think it is more than 90%. So everyone is focusing on France, obviously, because in Germany, as I said, it is already done. So end of the story, nothing to be added in terms of value. So basically, really, France is the asset. So when you combine, remember, the yield, which are compressed to 3.5%, and when you see the rental value increasing as well, so the French dorsal, meaning from Calais to Marseille, so north-south, you see that we used to have a rental value at 45 a square meter. It is no longer the case. It has increased up to 58, 60 when you have specific. So if you double the increase in the rent value with the compression of yields, you see that logistics can be a worth asset. So it is really something exciting in terms of logistics, because everyone is looking at logistics and the market is beginning limited. In France, I guess it is the same. It is more and more difficult to construct, to build logistics in France, mainly because of zoning, because of administrative authorization. So it means at the end of the day that in terms of investment, prices are increasing. And so everyone is looking at that. And the main question for investors is to have the knowledge, the capacity, and so is the premium for existing logistics platform.
Okay, Q&A now. We're very modern in a hybrid world today, so we can have questions from our audience that have joined us digitally as well. You can type that, I think, in the chat box, and then hopefully, if everything works, it gets WhatsApped to me, and I can ask it. So if you are in the audience digitally, do feel you can ask a question. We also have a microphone here as well for any questions from the audience. Just very briefly, a couple from me. You've both touched on the logistics sector there, which absolutely is sort of flavour of the month, have you seen from many of the charts. I'd love to know from both of you, I think both of you are sort of confident in it now, but what are the signals we should be looking out for to say, okay, this is now a bubble? Because the cynical journalist in me hears about everyone being interested in the same sector and money piling into a sector and thinks, well, that's got to go wrong at some point. So what are the signals to be looking out for that logistics becomes a bubble? Sabine, I'll go to you first.
Maybe monitoring closely tenant demand. I mean, one of the big questions earlier was, or to us was, has Amazon just cannibalized all of its next 5 years demand during the pandemic? Are they just brought forward 5 years of growth and just like hyped it up now? So I think just looking at how the evolution of tenant demand proceeds. And then the other one is just being fine-grained. I mean, if you believe, as I think we probably do, that we're past peak globalization as people realize how fragile some of those supply chains are, would you rather be, do you want to be in big gateway logistics, you know, the big boxes that are on airport runways and ports? Would you rather be oriented towards your domestic supply routes? So I think it's all about tenant demand, but also being having a view on the logistics is huge, right? It covers a big group of very different and heterogeneous formats.
I would say also we have to look at the government as well. In France, you can definitely see some reluctance towards Amazon, for instance. I guess people mentality is shifting a little bit. and I can definitely tell. We are, I would say, 10 years maybe late compared to the UK world. So it means that from what I see, we are shifting to e-commerce only right now. So I would not be pessimistic with respect to logistics right now, subject to French government, which is for electoral purpose, I think, battling against the GAFA, we say, so Google, Amazon, blah, blah, blah. And so subject maybe to government highlighting the loss of little shops in the city center, I don't see much of a concern right now. The concern could come from the prices and also from the way the distribution will go. We can see definitely that you have last mile logistics coming up. So it will be very interesting to see the shift in logistics as well. So you will have these huge logistics in the suburb, but also you will have to find the last mile small part. And I think you will see that offices shifting also. You will have a lot of parking spaces empty, because if you don't have workers there, you will have to, let's say, do something about that. And you will have a smart way to maybe do something about this and have this last mile logistics. So it might very well be that it will turn from jumbo platforms to maybe smaller one, and to find some relay to deal with this distribution.
Sure. And Sabina, you mentioned retail, which obviously is the sort of opposite side of the coin from logistics, and how that might be a kind of buy in certain sectors in certain countries. I mean, is that factoring in the capex that's going to be required as well to kind of make retail, future proof?
Yeah, I mean, what's fascinating now is we've got so much more price discovery and knowledge about retail and what has performed through the pandemic. And, we've got shopping centres in Europe who trade brilliantly, they're fully occupied. You probably, selling them would be really challenging, but there is more knowledge than there was 5 years ago. And I think it's easier to underwrite now, even with your change of use or your capex or whatever it is that you're going to do. Whereas with the logistics, I don't think any of us really truly know what the new trend yield is and when we've breached it. Does it settle at 3.5? Does it settle at 3 or 4? And then the other thing is all the technological disruption has happened to retail. All the technological disruption is ahead for logistics. What happens when you have driverless convoy vehicles that can deliver stuff and where they don't need to stop every 6 hours because there's a human, and therefore the whole reconfiguration of the supply chain? What happens when it's drone delivery? What does that mean for where your last mile delivery stop is? And if you want to go really global, this is a global outlook. What happens when the Bering Strait is navigable year round because of climate change, and suddenly where the major ports are totally shifts? So it just feels to me that there's retail actually in some ways, I would argue, is easier to value and underwrite than logistics right now.
And Denis, from the continental point of view, you talked about how logistics is maybe a few years behind. Is the same true as retail? UK and US retailers obviously been through that firestorm. European, French, not quite so to the same degree. Do you think maybe there's pain to come on the retail side, on your side of the channel?
Yeah, I think retail is suffering quite hard from this change in the economic. I would say we don't see much huge mall in France, at least. We have a few, but not too much. So it means that retail is mainly high street retail in France. So hopefully, I would say, with the big brand, high value brands, you will see retail staying. But with, let's say, less value-added brands, they might suffer a little bit. What is really also important to see is that you have a mix in between logistics and retail. We see a lot of shops with like a messagerie. So it is the place where you can take your delivery from your logistics, So it's a sort of in between, So we are shifting. And so we will have small shops, to say, fancy, but you will take up your delivery. Yeah. So this is where I would see the two things merging, hopefully. But yeah, I think the delivery is the main concern right now, because with employment regulations, it is quite difficult, because logistics and delivery implies, let's say, not so well paid employees. If you want to be worth,
Not anymore if you're an HGV driver.
yeah,
Probably better paid than a corporate lawyer and economist now.
yeah. We don't have autonomy driving in France, you know, so I don't see that. But yes, it will be the next challenges. If we want to shift, really, we will have to find a way to have this delivery working on an efficient way, and definitely it is not yet the case.
Sure. We've got some questions coming in digitally, but we'll go to the audience who've kind of come in today. Has anyone in the audience got a question? Wait until you get the mic so that people online can hear you. But any questions in the room at all? Must be one. Go on, Bonnie. No, hang on. Wait until you've got the mic, because then the people online can hear you. Go for it.
Well, thanks to all three of you. But Mike, I'm just interested. You call yourself a cynical journalist, but what's your readership really interested in? I mean, you're one of the biggest platforms. What's the key story, or what do people want to know, or what are they searching?
So there's an almost infinite capacity. I'm quite bored of writing about the future of the office at this point, but our readers certainly aren't bored of reading about it. And that's completely understandable, because obviously the real estate industry is long office, and how demand for office space plays out is of vital importance to real estate, but also to society, right? We kind of organize our society. A vast swathe of our society is organised around coming into the office 5 days a week. So changes in that will be absolutely huge. So yeah, our readers are very, very interested in that. You know, a personal view, you know, I'm probably going to be quite unpopular in the room. I think I see a lot of parallels between how 10, 15 years ago people thought that online is only ever going to eat up sort of 20, 25% of the demand for retail. So often, you know, and therefore my shopping centre will be fine. And that happened, and physical retail is having a really, really bad time. I think a lot of people in office think their office will be fine, and everyone else's office will not be fine. You know, if people aren't coming in sort of 2 to 3 days a week, that's potentially more than 20% demand coming out of the office market. So I think the industry has its head in the sand a lot at the moment, and everyone thinks their product will be all right and everyone else's won't, which is kind of human nature. And then beyond that, I mean, life sciences. I mean, it's been the most incredible boom in life sciences. Our readers, again, can't get enough of kind of reading about that. There's only about 5 life sciences schemes in the whole of the UK, but everyone wants to buy into them because of, exactly as Sabina said, that kind of demographic secular growth. So people are really, really interested in that. And I think, you know, the pricing in that sector has advanced even more rapidly than, say, build to rent, because, again, all of the investors want to get in there, but there's even less product available than in rented residential. So, yeah, thank you.
Yeah. I think we haven't talked much about residential and services for elderly people or healthcare. I think it might very well be the next trend as well, because if you see offices, empty offices, you know, we will have to find a way to recycle those spaces, and we can see that the people are getting older and older with demand of healthcare, of services, and everyone is thinking about it in order to see a different way. You have build to rent in the UK. We don't very much, but I think the next step for at least France and maybe continental Europe will be to find a new way in terms of residential, to find services, medical services for every single class of people with handicaps, older, elderly, because we are very, very far away from what we should be. So I think it will be the next trend, maybe.
Sure. A couple of questions that have come in from the online audience, both from Stephen Cox. We'll go with the green one first. So Sabina, climate change / the green agenda, opportunity or cost?
Both. You've got to underwrite your capex and indeed your insurance costs if you're near water or in any kind of zone really well now. I think most people, we thought this before the pandemic, that most people were really underestimating the capex involved in keeping an office in particular up to the current and future ESG regulations, particularly in Europe, because this is where they were proceeding apace. But in the US with the election of Biden and the green agenda there, I think it's, that was a big step change in how you had to view underwriting there. But it's a huge opportunity, and it's an exciting opportunity. I think if we're going to get smart, motivated, ambitious, earnest 20-somethings into this industry, which we should want, one of the ways we motivate them is by saying, we are the people who control and operate the built environment, and we have this amazing opportunity to create something that actually is doing good in society and is making a step change. So I think it's one of the topics that is the most exciting, and why I feel that I'm really motivated when I read investment committee memos where we're transforming space personally. I think it's just phenomenal. It's such a good opportunity, but we've got to get our skates on, right? But it's going to bring people into this industry who previously wouldn't have considered us because they thought it was financial services, because there's such a capacity to make a change.
Sure. Denis?
Well, I thinking about offices against logistics in terms of green, and how we can turn those assets into a better environmental, way. Logistics are now turning to green already, and logistics offer a great opportunity with solar panels. Basically, you have 50,000 square meter of logistics. It is easily a solution to put solar panels on the roof or on the parking spaces. So it is quite easy this way. From what I see for continental Europe, we are still work to do in terms of storage of electricity, because the issue right now is it is easy to have a self-sufficient property. It is a second story to do something about the excess. And so because of governmental monopoly, governmental authorization, it is today at least quite an issue to put together a storage capacity and also to do something with this excess of electricity. So we are at the beginning, but I think logistics definitely offers opportunity. And so you already provide for that from the from the outset, basically, of the construction. So most of the logistics now are fit to put on the top solar panels. So it is already under the radar. Next will be the implementation. So it will be much difficult. But for offices as well. So you mentioned a lot of capex. We see in La Défense, for instance, you have to put a scaffolding at the exterior of the building in order to put the all the stuff to insulate your property. These represent huge capex, and so it will be a challenge. But still, most of the people are willing to pay a premium if it is greener, and you can see definitely from the user side of the investment that you can find a win-win situation as far as capex are concerned between tenants and landlords. So it is the historical trend to have the portfolio greener and greener, and people are willing to pay.
Sure. Well, saving the planet, I think, seems like a good point at which to end. So I'll invite Chris up to close us off.
Thanks very much, Mike. We're just a couple of minutes over. So if you need to get to your next meeting, then please do run. And if you can stay, have some more coffee and conversation. But first, can we all thank three speakers for their fascinating